Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of corporate filings and sometimes find out that companies wish they printed less stuff today. We are diving deep into a filing from Blaize Holdings incorporated their S-1 registration statement. And honestly, some of the numbers here are quite something before we jump into what makes a company tick, or in this case, almost to consider subscribing and join. In our Discord too, where we break down these filings even further. It is linked in the description below. Let's start with the big picture of what Blaize does. They create artificial intelligence-enabled edge computing solutions, marrying hardware and software to optimize AI from where data is collected, all the way to data centers. Their goal is real. Time insights with low power and low cost. But as we will see, achieving that goal has been a challenge. This filing is all about registering shares for resale by some existing stockholders called selling stockholders. Essentially, they want to sell a lot of their shares, mostly common stock, and some that can be acquired by exercising warrants. That is a big chunk of shares the selling stockholders could potentially dump on the market, which is always something to watch out for. But the key takeaway here is that Blaize itself is not getting any of the money from these sales. The selling stockholders are handling all those costs. This filing is really about letting them sell what they already own or can get. This tells us they are a publicly traded company, which is great for transparency. Now let's look at the money. This is where things get really interesting. For the year 2024, Blaize had total revenue of about $1.6 million. That sounds pretty low, right? Especially when you look at 2023, they had revenue of about $3.9 million. So their revenue dropped significantly by about 60%, which in real terms means they lost nearly 2/3 of their income from the previous year. This drop is mainly because a big engineering services contract with a related party ended. They did get a little bit more from hardware sales, but it did not come close to making up for the lost services revenue. And the costs, look at the costs and expenses for 2024. They spent almost $50 million while bringing in only $1.6 million. That is a massive hole they lost from operations, a staggering $47.6 million in 2024 compared to $38.5 million in 2023. So not only did revenue go down, their losses per operation went up too. This is a really important point. Their costs are growing faster than their revenues, and that is never a good sign for long-term health. And the net loss is even worse. $61.2 million lost in 2024 compared to $87.6 million lost in 2023. So while they lost less money overall in 2024 than in 2023, that is mostly because some big one-time charges from 2023, the pay-to-play financing charge, for example, are gone. It is not necessarily because their core business is doing better. Now, for the more recent numbers, for the first 9 months of 2025, their revenue jumped to almost $15 million. That is a huge jump from about $1.6 million in the same period of 2024. That is an increase of over 850%. This massive revenue growth seems to be driven by hardware sales to new customers, especially one in Asia Pacific, bringing in over $10 million. But here is the catch: their costs also went way up. Their cost of revenue, nearly $10 million for just 3 months in 2025. That is a huge increase from the $476,000 in the same period of 2024. This is directly linked to selling more hardware, which is good, but it is also eating into their profits significantly. They are making progress, but it comes at a high price. And their research and development costs are also soaring, going up 106% to over $32 million for the first 9 months of 2025. This is understandable as they are developing new chips, but it shows they are spending a lot to try and grow. Selling and administrative costs are also skyrocketing up 177% to over $40 million for the same 9-month period. A lot of this is due to stock-based compensation costs, which can be a big deal for companies trying to attract talent, but it also means they are spending a lot to run the company and sell their product. So what does this all mean for their losses for the 9 months of 2025? Their loss from operations reached over $82 million. That is more than double the loss in the same period of 2024. Their overall net loss is also a staggering $203 million for these 9 months. This is a really significant point. They are burning through cash at an alarming rate. And if you look at their cash position, they have about $24 million left, but they used nearly $57 million in just operating activities in the first 9 months of 2025. This is why you see that big warning about their ability to continue as a going concern. Their auditor explicitly stated, "There is substantial doubt companies that are burning this much cash often need to raise more money quickly, or they could face serious problems." This is a serious red flag for investors. It means the company might not be able to stay in business for the next year without more funding. Now let's talk about risks. This filing has a whole section dedicated to them, and it is extensive. Some key ones include their history of operating losses and the uncertainty of ever reaching profitability. They also depend heavily on a very small number of custo. MERS, which is a big risk. If one of those big customers leaves, they could be in serious trouble. This is a classic warning sign for businesses, especially new ones. Losing even one of these few customers could be devastating. They also talk about long-term partnerships with automotive companies, which is interesting, but they will not get firm purchase orders until they deliver their auto-grade chip. This means a lot of potential future business is still very uncertain. This delays their ability to lock in revenue and makes their financial future even more unpredictable. This sounds like a company still very much in the development phase, praying their next big product. Hits the marks and competition is fierce too. They are up against big players like Nvidia and Intel in the AI chip space, a very tough market to crack. So what is the story here? Blaize is in a high. Stakes game developing cutting-edge AI technology for edge computing. They have seen some revenue growth recently thanks to new contracts, but their costs are soaring and they are losing a lot of money. The warning about their ability to continue as a going concern is a major concern. Their strategy seems to be focused on expanding their product lineup and partnerships, but the path forward is fraught with peril. They need to convert their promising pipeline into actual sales. Without running out of cash, the competition is intense, and their reliance on a few customers is a major vulnerability in my opinion. Blaize is a high-risk hide. Reward play, they have innovative technology, but the market is tough and they have a long road ahead to profitability. The recent revenue jump is encouraging, but overshadowed by the massive increase in costs and their precarious financial position. Investors need to be very careful and understand that this is a very speculative investment. What is your take on Blaize's prospect? So you excited about AI at the edge or worried about their financial runway? Let us know your thoughts in the comments below. If you found this breakdown helpful, please give us a thumbs up and subscribe for more corporate deep dives. You can also join our Discord community linked in the description for more discussions like this. Thanks for watching and we will see you in the next episode of Corporate Decoder.